The move-up market in San Diego kind of died this last year. Sales volume dropped to one of the lowest levels on record, even as mortgage rates eased up. But here's the strange part. Prices, they didn't collapse. That disconnect tells us a lot about what's really happening in this market. And at the same time, nationally, the gap between renting and buying just hit its smallest level in 3 years. Buyers now need about $35,000 more in income than renters, at least on paper. But in San Diego, that math looks radically different. And that different matters if you're trying to decide whether to keep renting or to finally make a move in 2026. All this and more covered in this week's San Diego Market Matters, and I'm Karl, your San Diego realtor. Now, if you want clear, grounded insight on what's actually happening in this market, make sure you're subscribed. And if by the end of this video, if I've earned it, feel free to like the video then. Now, let's dig into this. Let's start with the headline number. According to Adam Data Solutions, San Diego County recorded 27,117 home sales in 2025. That makes last year the third lowest sales total going back to 1988. The only years lower were 2023 and 2024. And we're not talking about mild slowdown. We're talking about a historically low transaction volume count. And here's what makes that number even more interesting. Sales last year were lower than 2007 during the housing crash, when foreclosures were everywhere and prices were falling fast. They were also lower than in the mid-1990s when the country had fewer residents and a sluggish economy. That comparison alone should make you pause. So why didn't prices collapse then? Well, based on this source, the median home price in December was $865,500, up 0.3% year over year, essentially flat. Single-family homes were sitting just under $1 million at $986,800, down from the peak of $1,040,000 last spring, but nowhere near a free fall. Condos and townhomes came in at $660,000, also off their all-time highs, but holding firm relative to history. And that's the disconnect here. Volume collapses, but prices didn't. And the biggest reason is the freeze in the move-up market. Millions of homeowners locked in mortgage rates at 2 to 3%. Trading that for a 6% loan on a higher priced home simply doesn't make financial sense for most households.
Agreed. Totally agreed.
So instead of selling and moving up, they're staying put. And when we don't see people sell, inventory doesn't expand in a meaningful way. Even though we saw inventory peak around 7,400 homes in June, it plummeted to less than 4,000 homes by the end of the year. That's historically tight for a county this size. Limited supply prevents the kind of forced price correction you normally expect with low sales. There's also this tax element quietly reinforcing this freeze. Many longtime homeowners bought decades ago at dramatically lower prices. Selling today can mean large capital gains bills, even after exemptions. And for a lot of boomers sitting on substantial equity, the incentive is more so to age in place rather than to trigger a taxable event like this. Meanwhile, mortgage rates did ease up. The average 30-year fixed rate fell from just over 7% at the start of the year to around 6.15% by late December. That helped stabilize payments somewhat, but it wasn't enough to meaningfully expand the buyer pool. And that's the point here. Low sales volume doesn't automatically equal a crash. Crashes happen when supply overwhelms demand. But right now, demand is restrained by affordability, but supply is restrained even more by locked-in owners. That balance is what keeps prices from breaking down. What we're really seeing is paralysis. Fewer first-time buyers can afford to enter. Fewer move-up buyers are willing to give up their rate. Sellers don't feel pressure because equity levels are high and unemployment is still relatively low. So transactions shrink, but pricing just floats sideways. And then there's this other layer here that doesn't get talked about enough. A slow market doesn't just affect buyers and sellers, it affects the entire ecosystem. Loan officers, escrow companies, appraisers, and agents all rely on transaction volume. When sales drop to near record lows, that ripple effect is very, very real. So here's your takeaway with my personal touch of some case spice. The move-up market didn't disappear because people didn't want to move. It disappeared because the financial incentive vanished. And the longer this market moves sideways, the stronger that incentive becomes for those low rate owners to hold on for even longer. Think about this with me. Every year that goes by, those 2 to 4% mortgage rates become even more valuable. Even if rates eventually come down, it may make more sense for a move-up owner to keep that property, rent it out, pull equity through a HELOC, and then buy the next home without selling that first one. If that dynamic takes hold, the next hot market cycle could look very different. Instead of sellers freeing up inventory as they move up, we may see more buyer-only competition layered on top of already constrained supply. That would mean stronger demand without the usual inventory leaf that historically accompanies move-up activity. So while sales volume is low today, the longer this freeze persists, the more future pressure may quietly build under the surface. Not because the market is crashing, but because the incentives are shifting. If you're sitting on a low rate mortgage and trying to figure out whether to hold it, rent it, or reposition, that's not a one size fits all decision. It depends on your equity, your income, and your long-term goals. And that's a conversation I'm always happy to have with you. But at the end of the day, this all comes down to math. Incentives change when the numbers change. And nationally, the numbers are starting to move in a direction that's getting some attention because the gap between renting and buying just narrowed to its lowest point in 3 years. And supposedly, this means affordability is improved. The national numbers are pretty straightforward. In December of 2025, the typical buyer needed to earn about $111,000 per year to afford the median priced home nationally. The typical renter needed to earn $76,000 to afford the median rental. That's a gap of about $35,000, which sounds large, but it's the smallest spread we've seen in 3 years. And a year ago, that gap was wider. Buyers needed closer to $116,000 and the premium over rent was more than 55%. At its peak in late 2023, the gap was over 66%. So technically, buying has become slightly more affordable relative to renting, mostly because mortgage rates have eased up from near 7% to around the low 6s, while renting has continued to rise modestly year over year. On the surface, that sounds encouraging. Monthly mortgage payments nationally are down compared to last year, and buyers in many markets have gained more negotiating power. Price growth has slowed, concessions are more common, and some sellers are having to meet the market instead of being giant market dictators.
That's why I added the tater.
That's very different from the frenzy we saw in 2021 and 2022. Here's where San Diego separates itself from the headline. The median home sales price here is around $900,000 based on the Redfin article. To afford that at today's rates, the buyer needs to earn roughly $231,000 per year. To afford typical rent at about $28.89 per month, you need to earn about $115,000 per year. That means the income required to buy in San Diego is still about double what's required to rent. Yes, the premium narrowed slightly year over year, down about 6 to 7%, but we're still talking about a 6-figure income gap. That's not a minor difference. That's a structural barrier for a large portion of the population here in San Diego.
You're folding my dreams.
So when you hear that the rent versus buy gap is shrinking, that's true nationally and even locally. Technically, the numbers have improved slightly compared to last year, but shrinking from extreme to slightly less extreme doesn't suddenly make the math any easier. What this really tells us is that this market is stabilizing, not transforming. Mortgage rates have backed off from 7% to the low 6s, and that helps. Slower price growth helps, wage growth helps, but in high coastal markets like San Diego, income is still the gating factor. The other piece of this story is leverage. The article points out that buyers in much of the country now have more negotiating power than they've had in years. And we're seeing some of that here as well. Homes sitting longer, price reductions happening more frequently, and sellers offering credits are all part of this more balanced environment. But leverage, well, it only matters if you can qualify and comfortably afford the payment in the first place. Negotiating $5,000 or $10,000 off of a purchase price doesn't solve a $100,000 income gap. That's why this conversation has to be grounded in personal numbers, not headlines. So here's the takeaway from my perspective. Renting in San Diego is still radically less expensive than owning. In many cases, the monthly mortgage payment is close to double the rent for a comparable property. And that's before you factor in maintenance, repairs, insurance, and that unpredictability that comes with home ownership. Even if mortgage rates drift a little lower, it likely won't be enough to close that gap meaningfully. That income and payment delta will continue to limit how quickly the buyer pool expands from here. And in a market like San Diego, a contained buyer pool naturally puts a ceiling on how aggressively prices can run, even if rates ease further. And there's another side to that too, that gap. It gives renters time to grow income, build savings, strengthen their credit, and position themselves better for ownership later on. That's assuming we can keep the Sunset cocktails to 2 nights a week. Please.
You're asking too much of me.
Affordability may be stabilizing, and you can even say improving, but the rent versus own spread is still pretty damn wide. If you're trying to decide whether buying makes sense for you in this environment, the right move isn't based on headlines. It's based on your numbers. Now, if you want to walk through that math in a real way, feel free to reach out. And that's a wrap for this week's San Diego Market Matters. If you have any thoughts, questions, or concerns, don't hesitate to reach out. And if I've earned that like today, now's the time to show it. As always, I'm Karl Kyler, your San Diego Realtor. I'll see you in the next video.